Active investing involves trying to outperform the market. Investors or fund managers carefully select specific stocks or assets they believe will perform better than the overall market. They analyze company financials, industry trends, and economic conditions. The goal is simple: buy undervalued investments and sell them when their prices rise. Active investors believe that with enough research and skill, it is possible to beat the market. Passive investing follows a very different philosophy. Instead of trying to beat the market, passive investors aim to match the market's performance. This is usually done by investing in index funds or ETFs. These funds track market indices, such as large stock market benchmarks. The idea behind passive investing is simple. Markets are difficult to consistently outperform, so rather than try and predict winners, investors simply invest in the entire market over long periods. This strategy has proven effective for many investors. One of the biggest differences between active and passive investing is cost. Active funds usually charge higher fees. This is because professional managers research companies, analyze markets, and make frequent trades. Passive funds typically have much lower fees. Since they simply track an index, they require less management. Over long periods, these cost differences can significantly affect investment returns. Even small fees can compound into large amounts over time. For decades, investors have debated which strategy performs better. Some active fund managers have successfully beaten the market. However, many studies show that a large number of active funds fail to outperform market indices over long periods. Passive investing benefits from simplicity and consistency. Active investing relies heavily on the skill of the investor or fund manager. This makes performance less predictable. Active investing requires time, research, and discipline. Investors must constantly analyze market news, company earnings, and economic data. Passive investing, on the other hand, requires far less effort. Once an investor chooses an index fund, the portfolio automatically follows the market. This simplicity makes passive investing attractive for people who prefer a long-term approach without constant monitoring. Risk also differs between these strategies. Active investing involves concentrated decisions. Choosing the wrong stocks can lead to underperformance. Passive investing spreads risk across many companies in an index. This diversification helps reduce the impact of individual company failures. However, passive investors must accept market-wide downturns. Active investing may work better in certain situations. For example, in inefficient markets where information is not widely available, skilled investors may identify undervalued opportunities. Active strategies may also work during volatile market conditions. However, success depends heavily on expertise and discipline. Passive investing often performs well in efficient markets. In such markets, prices quickly reflect available information. This makes it difficult for most investors to consistently outperform the market. Passive investors benefit from broad diversification and low costs. Over long time horizons, this combination can create strong wealth accumulation. Many investors choose not to follow only one strategy. Instead, they combine both approaches. A core portfolio may consist of passive index funds, while a smaller portion may be allocated to active investments. This approach allows investors to benefit from both diversification and potential outperformance. Active and passive investing are not enemies. They are simply different philosophies. Active investing focuses on skill, research, and market opportunities. Passive investing focuses on simplicity, diversification, and long-term discipline. The right strategy depends on the investor's goals, time commitment, and belief about how markets work. Understanding both approaches allows investors to make smarter financial decisions.